All right, so Jay Powell says the market seems a little frothy. I'm going to just translate what he's trying to say. I think everybody's saying that, but people keep putting their money into the markets, and it keeps moving to highs. Do you think that this is sustainable, specifically with so much money pouring into the AI trade?
Look, I think Jay is clearly trying to manage expectation around how many rate cuts we should be expecting, not only for the balance of this year, but as we move through 2026. The Fed is in quite a tough position, Frank, given what's happening with the other side of the mandate, mainly inflation, while employment is clearly softening and coming down. So is the market frothy at these levels? We are near sort of historical highs from a multiple perspective, but I have to give the chairman credit. He could have said it was irrational exuberance, and he didn't go there.
I think that would have had a much bigger impact on the market. I just want to talk to you about some of the announcements that we had this week, whether it's NVIDIA and OpenAI, other announcements in the market that seem to be pushing and pulling on the AI trade. It was also that report from Bain saying that AI companies are going to face a shortfall of revenue up to $800 billion by 2030, which is a short time away and a long time away. It just depends the way you look at it. Do you have confidence that this AI trade can continue to power the market, or do we actually need rate cuts? I was actually at the New York Stock Exchange yesterday. A number of those traders say we don't actually need the rate cuts. We have enough productivity in the economy to keep the market moving higher.
Look, if you look at macroeconomic conditions, it's hard to argue that you need big rate cuts. But clearly the Fed is at a point where they are going through somewhat of a mid-cycle adjustment. But let's talk about the AI trade and the sustainability. We think at Columbia Threadneedle that we are on a glide path towards $3.5 trillion of spending. So we are in the very early days. We know that the balance sheet capacity is clearly there for the hyperscalers as they continue this CapEx spending. And what we're seeing is that there's an ample amount of private capital that's willing to step up and support this. So the net and short of it is we would expect AI to continue to be a place of strength for the economy. Is it going to be linear, straight up? Probably not. But
well, I mean, it can't be linear. But I think the question is, can it keep going up and to the right? Or do you see a pullback in some case, or a possibility of a pullback coming up, whether it's earnings not meeting very elevated expectations? Because earnings are the other thing a lot of people think are propping up this market right now.
Yeah, there's always the possibility of a pullback, but we do think that we're headed towards about $3 trillion of spending. I think the thing that is going to be really important right now is the market is now starting to look for evidence that this CapEx is going to have payback in the form of returns. So that's the thing that we're paying most attention to. You need to start to see evidence of that, or market participants will start to worry. But again, we are in the very early days of this spending, and we're not seeing anything that is worrying per se.
A lot of confidence in the AI trade. What about the broadening? Again, a lot of people do believe we're on a rate cutting cycle, whether we need it or we don't need it. Does that mean we're going to see a broadening? If you look over the last week with the S&P equal weight and the S&P market cap weighted, they're trading pretty closely. The market cap weighted one's doing better in all fairness, but they're trading fairly closely over the last week. Are you bullish on the idea of a broadening? And if so, where do you want to put money to work?
Look, we could have talked about a broadening for 3 to 4 years now, right? And the evidence is every time we've talked about this, the market has gone back towards the mega caps who have led the way. But we do think the conditions are now in place. Look, we've talked about rate cuts. That is going to introduce potentially some cyclicality back into the marketplace. And when you get that, the best way to take advantage of that cyclicality and that beta would be in the form of the Russell 2000. The market clearly is indicating that they think that that's where things are going, just judging by the performance of the Russell over the last 4 to 5 weeks.